Welcome back to Elite Economics, where we decode the mysteries of finance for you. Today, we're embarking on an adventurous journey, navigating the labyrinth of hedge funds. These financial titans often make waves in the news, yet understanding them can feel like trying to solve a cryptic puzzle. Our mission is to illuminate this shadowy corner of the financial world, transforming the complex into the comprehensible. From their inception to their intricate operations and their wide-ranging impact on the global economy, we're about to uncover the enigma that is hedge funds. Whether you're a seasoned investor or a curious novice, we're here to unravel this tangled web. So, buckle up as we delve into the intricate world of hedge funds, exploring their strategies, their effects on the economy, and how you can safeguard your personal finances against their potential pitfalls. By the end of this video, you'll have a clearer picture of what hedge funds are, how they operate, and what their impact is on the economy. So what exactly is a hedge fund? Well, imagine a colossal pool of money. This pool isn't filled by just anyone, but by a select group of individuals and entities. We're talking about high net worth individuals, those with significant financial resources, and institutional investors like pension funds, endowments, and insurance companies. These contributors entrust their money to professional investment managers who run the hedge fund. Now here's where things get interesting. You see, a hedge fund isn't your run-of-the-mill investment vehicle. It's not like a mutual fund or an exchange-traded fund, which have to follow stringent rules and regulations. No, a hedge fund is a different beast altogether, with far more flexibility in its investment strategies. The managers of hedge funds, often referred to as hedge fund managers, have the freedom to invest in a wide variety of assets and use complex strategies to generate returns. They can dabble in stocks, bonds, currencies, commodities, and derivatives. They can go long, betting that certain assets will increase in value, or go short, wagering that certain assets will fall. Furthermore, hedge funds can be as diverse as the wildlife in a tropical rainforest. Some hedge funds focus on specific sectors or regions, others might concentrate on certain types of assets, while some could be geared towards more opportunistic short-term trading. The common thread is that they all aim to generate high returns for their investors. Now, with the freedom and flexibility that hedge funds enjoy, come certain risks. These investment vehicles often employ leverage or borrowed money to amplify their potential returns. However, this can also magnify the potential losses, turning a minor market downturn into a major catastrophe for the hedge fund and its investors. Unlike mutual funds, which are subject to strict regulations, hedge funds have more flexibility in their investment strategies. This flexibility allows them to potentially achieve high returns, but it also means that they carry a higher level of risk. So, as with any investment, it's crucial to understand what you're getting into before you dive in. Hedge funds can employ a variety of strategies to generate returns for their investors. These strategies, in essence, form the backbone of their operations. So let's delve into the most common ones, shall we? First off, we have the long-short equity strategy. This is where hedge funds buy stocks they believe will increase in value and simultaneously short-sell stocks they predict will decrease in value. This strategy aims to profit from both the rising and the falling markets, hence mitigating risk. Next up is the event-driven strategy. Here, hedge fund managers capitalize on price discrepancies that may occur before or after a corporate event, such as a bankruptcy, merger, or acquisition. They're essentially playing the role of fortune tellers, predicting how these events will affect stock prices. Then there's the macro strategy. In this approach, hedge funds make speculative investments based on predicted economic or political events on a global scale. They might invest in various types of assets like currencies, bonds, or commodities, depending on where they see potential. Another common strategy is arbitrage. This involves exploiting the price differences of a single asset in different markets. For instance, a hedge fund might buy a stock at a lower price in one market and sell it at a higher price in another. Lastly, we have the multi-strategy. As the name suggests, hedge funds using this strategy employ a combination of the aforementioned strategies, providing a sort of one-size-fits-all approach to investing. It's important to note that these strategies are not set in stone. Each hedge fund has the liberty to choose and adjust its strategies based on market conditions, investor expectations, and the fund's overall objectives. Hedge funds can be as diverse as the investors behind them. Some focus on specific sectors or regions, others on specific types of investments. Some hedge funds focus on long-term investments, seeking stable returns over an extended period. Conversely, others engage in more short-term, opportunistic trading, chasing quick profits in a fluctuating market. In the end, the world of hedge funds is a complex, dynamic landscape, full of diverse strategies and high-stakes decisions. But remember, with high potential returns comes high risk, so tread carefully. Now you might be wondering, what do hedge funds do for the economy? Let's delve into this. Hedge funds, with their vast pools of capital and varied investment strategies, play several significant roles in the economy. Firstly, they provide liquidity to financial markets. By actively buying and selling securities, they ensure a steady flow of capital in the market. This activity is crucial as it facilitates price discovery, the process by which the price of a security is determined by supply and demand dynamics. Without this continuous flow of buying and selling, financial markets could become stagnant, even dysfunctional. Secondly, hedge funds can serve as a substantial source of capital for companies. Whether it's investing in stocks of a promising startup or providing financing through debt instruments to an established corporation, hedge funds can help businesses expand, innovate, and create jobs. This injection of capital can stimulate economic growth and contribute to overall prosperity. But it's not all rosy. Hedge funds can also impact the economy in ways that aren't always positive. One of the key characteristics of hedge funds is their ability to take on high levels of risk in pursuit of substantial returns. This often involves the use of leverage, which essentially means borrowing money to increase the potential return of an investment. While this approach can lead to impressive profits when things go well, it can also amplify losses when the markets turn sour. This amplification can result in increased market volatility. In extreme cases, if a large hedge fund were to fail, it could potentially send shockwaves through the entire financial system, leading to wider economic instability. So, while hedge funds play a crucial role in providing liquidity and capital, their aggressive investment strategies and use of leverage can also contribute to market volatility. It's a delicate balance, and one that regulators, investors, and the funds themselves must continually navigate. Because they often pursue aggressive investment strategies and can take on high levels of leverage, they have the potential to amplify market volatility. This brings us to the question of how to prepare personally against hedge funds. While we may not have a direct influence over their activities, there are measures we can implement to safeguard our interests. One of the most effective strategies is diversification. This is essentially not putting all your eggs in one basket. By spreading your investments across a variety of asset classes such as stocks, bonds, real estate, and perhaps even some commodities, you can significantly mitigate the risk of being overly exposed to any single market downturn or hedge fund activity. Diversification can provide a cushion against the unpredictable swings of the market. Next, we have a powerful tool at our disposal: knowledge. Staying informed about market trends, economic indicators, and regulatory changes is crucial. This information can help you understand how hedge funds and other market players might be influencing the investment landscape. Regularly reading respected financial news sources, subscribing to relevant newsletters, and even attending financial seminars can help you stay abreast of the ever-evolving financial world. Remember, knowledge is power. Lastly, while we can do a lot on our own, there's no substitute for professional advice. A financial advisor or wealth manager can be invaluable in navigating the complexities of the financial markets. They can help you assess your risk tolerance, evaluate potential investment opportunities, and most importantly, develop a personalized investment strategy that aligns with your financial goals and circumstances. Keep in mind that every investor is unique, and a strategy that works for one person may not necessarily work for another. In summary, protecting yourself from potential adverse effects of hedge funds involves a mix of diversification, staying informed, and seeking professional advice. It's about being proactive, making informed decisions, and maintaining a diversified portfolio that can weather the ups and downs of the market. A financial advisor can help you assess your risk tolerance, evaluate investment opportunities, and develop a personalized strategy that aligns with your financial goals. Stay tuned to Elite Economics for expert insights, analysis, and discussions on the elite economics of tomorrow. We're here to demystify the world of finance for you, and we've got a lot more exciting content lined up. From the latest trends in finance and technology to in-depth analyses of economic indicators, we've got it all covered. But we can't do it without you. Your engagement and support make this community what it is. If you found value in this video, don't forget to give us a thumbs up. It really helps us out. Share it with your friends and family, or anyone else you think would benefit from understanding more about hedge funds. Don't miss out on our future content. Hit that subscribe button and ring the bell to get notifications every time we post a new video. Join the conversation and become part of the elite community driving the future of global finance. Welcome to Elite Economics, where knowledge meets elite insight.